Hello everyone and welcome to my channel. This is Random Guy on YouTube. Today I will be talking about the LoveSac Company. LoveSac is a small cap company with a market capitalization of $324 million. It trades on Nasdaq Stock Exchange under the ticker symbol LOVE. LoveSac is an American furniture retailer specializing in patented modular furniture system called sectionals. Sectionals consist of two combinable pieces, seats and sides, and custom-fit covers. To me, the products seem to be very practical. The covers can be washed in a washing machine. Sectionals are easy to rearrange and move. You can buy additional pieces if you want a larger couch, and they are made out of recycled plastic bottles. LoveSac also sells sound system which fits into the sectionals. A clever idea, but I think of it as more of a luxury niche product. You can also buy all sorts of other different accessories to sectionals. LoveSac also sells Sacs, a back seat filled with proprietary foam mixture. In the last 5 years or so, the company is growing at 44% annually. This is how the revenue would look like if the exponential growth would continue in future years. But the latest quarter was pretty bad, and the company guided for $630 million of revenue in fiscal year 2023. Please note the oddity that for this company, fiscal year 2023 ends in January 2023. $630 million is much lower than what would the exponential growth suggest, so we have to get our expectations in line with that. I could be totally wrong, but this is my projection for growth in coming years. We can calculate margins from the cost of goods and operating expenses. As you can see, the latest quarter was pretty bad from the margins perspective as well, and it seems like this is trending in the wrong direction. For the bad Q3, the company blamed higher promotional discount costs, marketing, trade cost, and warehouse costs. However, especially the trade cost is coming down, and in the last earnings call, LoveSac guided for 1.5% improvement in gross margin and 3.25% improvement in EBITDA margin. This is huge, and I don't understand why the market is not reacting to this change of trend. All of the costs seem to be pretty predictable and hugely dependable on revenue. If I scale the cost linearly with the predicted revenue and disregard Q3, this is what happens to the margins. Again, I could be completely wrong here. Now let's talk about profitability. Here is earnings per share chart. If we use the projected revenue and costs, this is what happens to earnings. 2.15 EPS in Q4, 2.16 EPS for the whole fiscal year of 2023, which ended in January, and 3.93 EPS for the full fiscal year of 2024. With trailing 12 months price to earnings ratio of 10.3, the company looks very cheap. My earnings projections would lead to PE of 5.4 in the current year and PE of 3.5 in the next year. Price to sales is also very low at 0.5, and the last time anyone could buy this company below this level was during the COVID crisis. Since the peak in 2021, the stock has dropped staggering 81% despite strong business performance. Now let's look at the balance sheet. It is notable that the inventory is increasing over time. However, this is, with the huge revenue growth, understandable. LoveSac prioritizes low delivery times for customers, and they can sell through all the inventory in less than a quarter. Otherwise, the balance sheet is strong with no long-term debt. LoveSac had strong revenue growth in the past, and despite the bad economic conditions, the management expects the growth to continue, albeit at slower pace. If you don't count the latest quarter, the company is very profitable, and the management already guided for higher margins in Q4. The valuation metrics are very low, PE of 10 and PS of 0.5, and the company has a very strong balance sheet with no long-term debt. The risk factor that needs to be mentioned is the still slowing real estate market, since people buy furniture when they are moving. The overall furniture industry is declining, and LoveSac is only growing by taking market share. Here is the full table Pause if you like. And here is the reduced table. Since the last time, my portfolio took a strong hit, and for the first time we are in negative territory. This is especially unsettling since the Nasdaq rebounded very strongly in the last week. I was looking for explanation how this could be and found out a strong divergence in the markets. My portfolio consists mainly of small capitalization stocks, and I should have tracked the small cap index since the beginning. There is a huge divergence between megacaps of Nasdaq and small caps of Russell 2000. Interestingly, I did not see anyone on the internet talking about this. To be clear, I have nothing against large companies, and I was even tempted to add stocks like Amazon, Google, or Tesla to my virtual portfolio, especially since Google and Tesla are the main parts of my real stock portfolio. But I wanted this channel to be focused more on smaller, less known companies that are not being hyped by everyone. I may add some larger companies to the portfolio in the future anyway, but right now large caps are mostly up and small caps mostly down, and I see a great opportunity in small caps. I was also tempted to double down on stocks like PagSeguro or Semler, but still they are not down huge and there is still plenty of other opportunities. I am not opposed to buying more of the same stock in the future, but in general I want to keep all positions small. My portfolio is down, but still outperforming S&P 500 very slightly, and I still think we will outperform both S&P and Nasdaq in the long run. The important thing is keeping the focus and not changing the strategy based on minor short-term fluctuations. Today, I will add another $100 worth of shares of the LoveSac Company to the virtual portfolio. Keep in mind that I am just a random guy on YouTube and not a financial advisor. Full disclosure, I do own shares of companies displayed on this slide, as well as shares of Tesla and Google in my real stock portfolio. Thank you for watching and see you next week.